Hello traders, it's Wednesday, January the 22nd. This is John Kicklighter, Chief Strategist for DailyFX.com. Here to give you your FX market wrap-up for the past 24 hours of trading. Some active movements in some very particular currency pairs. We'll talk about those. But more importantly, what we should expect in the 24 hours ahead, because that's when things really look to get exciting. Now, in this past 24 hours, we were looking for the possibility of breakouts from two particular benchmarks. The first of those was my benchmark for risk trends, the S&P 500. You can see here that we have quite a narrow ledge for this wedge pattern, and it looks like something that is inevitably going to end in a break. And I do think that it absolutely will end in a break, because we have seen for 3 or 4 consecutive trading days some exceptionally low activity market. But given this pattern, it's a terminal pattern, and given the low level of general activity for the market itself, which you can see here in this average true range, a gauge of activity, a gauge of market movement, we here too are exceptionally quiet. So when we see exceptional conditions, we know that they are unlikely to last for a long time. That's why they're exceptional. We're expecting a breakout. I'm expecting a breakout. Which direction it goes is ultimately what we're going to be most interested in, but don't get too wrapped up in the break and become more concerned about the follow-through. I know that a lot of people out there trade short-term breaks, and there is trading to be had. But really, we're still waiting for that medium-term swing, the true trend developments that we can really grasp if we trigger the right market conditions, the right fundamental themes. Now, for the S&P 500, clearly the bearing is still leaning higher. All right, we have a very aggressive bull trend, and a break is more likely than not to occur to the upside. But if we do get a break, we can start getting into the potential for a more meaningful retracement, one that we have certainly been overdue for quite some time. Refer back to the graph I showed you yesterday, where we haven't seen a 20% correction from the S&P 500 since the great financial crisis. And while we have had some corrections of note over the past years, it's not what we need in terms of a cleansing fire, especially when we look at the exceptional positioning of these capital markets, knowing that they are very, very heavily priced, or very highly priced, and the expectations of risk, which you see here in the orange volatility index flipped upside down, is exceptionally low. Now, if there was this high from the S&P 500 with a commensurate level of healthy risk appreciation, in other words, people were buying hedges for a possible downturn, I would be more confident in the bullish potential for further upside. But given that there is no exposure for that hedge, given that there is an excessive amount of leverage behind these markets, something that we refer to quite often, and that we have extremely low levels of participation, I don't think that this is a bullish view that will sustain itself without a meaningful correction. All right? So we are still waiting and see for this very substantial underlying fundamental theme of risk trends. Now, the FX side of things. Of course, risk carries over to the FX, but we're also talking about the not only implications of risk on, risk off, as we traditionally call it, but also relative monetary policy. The US dollar is a big benchmark in both themes. All right, it's an ultimate safe haven currency, and it is really at the cusp of not necessarily the hawkish forecasts, but in the change. All right, it's really the change that matters to monetary policy, because that initial change in monetary policy is where we get the most movement from currencies. And we know that we have just recently seen the Fed tip over to the taper side, all right, back in December. And there's heavy speculation that next week they will, on Wednesday with their FOMC rate decision, carve off another $10 billion in the QE3 program. We'll see that potentially reinforced by the surveys for the primary dealers, as well as the relatively new market participant survey that the New York Federal Reserve is expected to release soon. But in the meantime, if there is a potential break, it could lead to something far more significant. As we were looking at in the congestion of the S&P 500, we similarly had a pattern here for the US dollar. We have an exceptionally low level of activity. Once again, the average true range using the 20-day, which is a one trading month measure, which one trading month is a very standard period. We did have a swing low down here last week, which actually matched the lowest level of activity we've seen in years. All right, so the probability of a breakout is very good. You pair that up with a technical pattern like this, where we have the ascending trend channel top, and we've had this recent support or resistance as new support. And this break from this 3-day congestion, which is essentially 30 pips, whereas we see that the average true range for the period is 40 pips. All right, we knew a break was inevitable. All right, but a bearish break that we see here, is this the dollar's next move? Is this the follow-through that we should expect? That's the question we should be asking. And I don't think that it is. I don't think that the break that we're seeing here is necessarily the clear, consistent signal for the US dollar. In other words, I don't think it has follow through. Not yet, at least. All right. If we had something like a full-scale risk aversion, if the taper had suddenly vanished, all its speculation, or if we had a substantially better performance from the yen and the European currencies, maybe. But we're not going. That's not on the docket right now. We're not running under those assumptions. So what drove the dollar to this break to the downside? All right, because clearly it's a technical break on the shorter time frame. Well, the dollar index is actually a composite of 4 particular currency pairs equally weighted. Euro dollar, we see there's a little nudge here to the upside. Pound dollar, a little nudge to the upside. Dollar yen, where the dollar has generally been underwater for essentially the previous 12 hours, but really the big performance came on the behalf of the Aussie USD. Big rally to the upside, and this move was actually substantial enough in the after hours trading or Asia trading session that it actually influenced the dollar's performance against these little nudge higher. That was actually a spillover effect from the Aussie USD. All right, so this big move was the instigation for this pretty tremendous, or I guess you have to look at the scale, but this technical breakdown. It doesn't really have a lot of momentum behind it. It's not really a big candle. On a daily basis, you can see that the body of the candle is essentially from 10.723 to 10.707. All right, so it's no more than 20. It's no more than 14 pips or so, or less. But this is a substantially small move, all right? But that is what happens when you have thin liquidity in these kind of market conditions, as well as a big move like this, all right? But the Aussie USD, can that single-handedly drive the US dollar itself to a substantial trend? Unlikely, all right? But let's look at the Aussie USD, all right? I want to look at this in terms of the fundamental trading potential, but I also want to look at the Australian dollar by itself. This was a move from the Australian dollar that was replicated against most of its crosses. Here we have the Aussie dollar. The Euro Aussie has started to pull back a little bit more towards that 153 level. If it breaks to the downside, then its target down towards 150. But this was a move that we registered here. The Pound Aussie, which is at the very top of this long multi-month trend, had a break to the downside. We had also an Aussie yen rally. All right, it was starting to flag a little bit after its initial bounce, and you can see that it regenerated its strength, moving up towards 92.50 once again. Even the Aussie Kiwi started to put in some additional gains after the New Zealand dollar had a big bump on the performance of its own inflation figures. All right, so across the board, the Australian dollar did exceptionally well. What was the catalyst? Well, the catalyst is what we've been talking about for some time now. It's the interest rate expectations for the Australian dollar. All right, essentially they are non-existent. In fact, there is speculation that the RBA could further cut rates. In fact, I mentioned in today's fundamentals released earlier that the Goldman Sachs a Goldman Sachs research note actually suggested that the Reserve Bank of Australia, the RBA, would likely cut rates once again in March. All right. I think this is actually pretty common or pretty familiar to what the markets in general are expecting. And that's why the Australian dollar remains so firmly underwater, why it's significantly weak against most of its counterparts. It's at the extreme end of the dovish curve, in other words. Because there are a few other central banks that are talking about a rate cut. All right. Most of them now are starting now in the early phases of speculation towards that eventual first rate hike. All right. But with the CPI data that we've had released this morning, all right, there was a material change in tone. We actually saw a better than expected reading, and the headline reading was 2.7%. The core figure essentially was approximately 2.6. So we're looking at data that is moving further and further up the yield curve. What does inflation do to central banks? It makes them act towards tightening. All right. Does this upgrade in the inflation figure actually force the RBA's hand? Not necessarily, but it does put the pressure back on. Just for reference, the Australian CPI figure is materially more provocative than the RBNZ. And we can see that the markets are fully expecting rate hikes from the RBNZ, and the central bank has certainly done as much as it can to reaffirm those expectations. But we actually have the market speculating on a rate hike from the RBNZ as early as this month. All right, but we're still expecting an RBA rate cut. All right, that is changed a little bit with this data. The question is whether it holds, whether we can move up the monetary policy curve from the extreme dovish to something a little bit more in the neutrality level. All right, somewhere in the middle. Not necessarily expecting them to turn immediately hawkish, but if they shift away from that suggestion that further rate cuts are possible to suggesting that they are fully set in neutral, that would be a material upgrade for the Australian dollar. But where would the Australian dollar benefit? Where would it do the most good? For the Aussie dollar US dollar pairing, all right. We're talking about two currencies at the same end of the extreme, and they're both moving towards the upper end of the boundaries. All right, so for Aussie USD, you're talking about the possibility of an RBA rate hike well into the future versus a Fed tapering that's occurring right now. All right. So unless the market starts to price in an RBA hike and the Fed starts to back off taper, and there is no risk aversion threat, the Aussie dollar would be actually a pretty good bounce. All right, but as you can suggest, or as you can surmise, this actually is not a very good probability circumstance because those are some very particular scenarios that are needed, and it's unlikely that we get all three. I think that one, risk aversion is highly likely, and if risk aversion were to kick in, Aussie-US dollar pairing would do exactly what it usually does under big risk-based movements. It would drop. All right. The taper speculation is likely to continue. It actually has backed off a little bit. Actually, this is a measure of the S&P 500 and taper interest among the markets. This is a number of news stories that cover taper. You can see that it's backed off substantially, but we are seeing more expectations of that move. And of course, as that monetary policy reality sets in, we're going to see the dollar benefit for it. So I think this has a better potential to the downside. The question is, how far can this bounce go? All right, that really depends on the dollar most likely from here on out because the Australian dollar has essentially leveraged as much as it can out of this week's fundamentals. I don't think speculation of an imminent rate hike is going to really evolve for the RBA. So this is actually not a good place to play the Aussie dollar to the long side. In fact, I'm contemplating going short, but the question is when can the dollar step up and really regenerate the bear trend? Now, for other pairing, Pound Aussie is not a good one. We'll talk about this in a second, but the pound is going to be exceptionally risky in the upcoming session because we do have a number of pieces of event risk related to interest rate forecast for the UK. All right, and if the UK rate forecast is finds some meaningful fundamentals to support it, because these markets are heavily pricing in a rate hike for the Bank of England sometime within this year, that, if reaffirmed, is definitely going to give the pound a significant advantage over the Australian dollar, and I would not be surprised to see this drive continue. All right. Now, Euro Aussie is a little lower threshold. All right. The ECB has kind of curbed discussion of a upgraded stimulus program, or a new LTRO. We'll talk a little bit about this in a second, but this actually is a currency that is certainly exposed to risky considerations. If risk aversion were to kick in, the euro probably would be hurt a little bit more aggressively than the Australian dollar. If we do see a pullback in or pickup in volatility or some destabilizing developments in the eurozone, then that can easily undermine the euro's own progress. You put that against an Australian dollar, which is at the very dovish end of the curve and starting to move its way up. That is a bearish versus an emerging bullish currency. The Euro Aussie, in other words, looks actually quite good for that. All right. If risk trends remain stable, the continuation on the Aussie yen looks good, although you have to measure your expectations both by the technical pattern and also risk stability, which is always an uncertainty in these kind of markets. And the Aussie Kiwi, once again, one of my top trades for 2014. We're at the very bottom of this massive range. All right, this upgraded interest rate outlook, although very tentative, and against the New Zealand dollar, who is almost certainly going to get a rate hike within, if not this meeting, then the following one. But we've priced in a lot for the New Zealand dollar. You've not priced in anything for the Australian dollar. So this has perhaps some of the best potential as well, next to the Euro Aussie. Now, I insinuated two things from recent developments. The Aussie dollar is unlikely to be your catalyst for the greenback itself going through the next 24 hours. That distinction is probably going to go to the British pound US dollar pairing. I dedicated today's strategy video specifically to the cable, but the upcoming event risk is very much major drivers for interest rate expectations. All right, as we've talked about a couple of times in these videos, the past 6 months have been a build-up in interest rate expectations, and they've helped the British pound to the gains that it's seen. All right, the pound dollar is a great example of these expectations and the strength that's provided, but we've seen it elsewhere as well, including the euro pound. I actually have this position, and it's still there. My stop is down at 82, but I might have to take this off. I'll make the decision before the actual event risk is released. I'll probably be up during this event risk, even though it's in the middle of the night for me, because it is important event risk. There is a very high probability of seeing volatility. But this particular setup, just like the pound dollar, both have great potential. If we are talking about interest rate speculation, if the data, which is employment data, as we see it move towards the 7% target that the Bank of England has placed in its forward guidance to suggest once we hit that target, we can start talking about rate hikes. If that unemployment rate continues to drop, it's expected to hit 7.3%. If it continues to drop towards that target, and the Bank of England minutes suggest that the central bank is actually leaning more towards a earlier start to its rate hike regime than the 2015 objective they suggested at their last quarterly inflation report, then that can really ramp the pound higher. All right, so pound dollar could break to the upside, euro pound can break to the downside. The pound kiwi could potentially ramp higher on these bigger trends. Pound Aussie also has a lot more room to run to the upside. Now, this, obviously, we just talked about the Australian dollar and how it's starting to move along that interest rate expectation curve. So this might not be the best one. All right. Same thing can be said with the pound kiwi. This one's going to be somewhat complicated if you're trying to play out a pound rally. All right. I am especially concerned about assuming that the pound dollar can break previous highs and continue along its way. All right, because we're talking about the Fed doing its taper, which is helpful for the U.S. dollar. And the dollar has shown some remarkable persistence and strength against most of its counterparts, holding back the pound here, but actually showing gains against many of its other counterparts. I'd prefer the pound dollar, in other words, if the interest rate speculation were to be dampened by the upcoming event risk. If you saw the pound drop off, the pound dollar would be a great play. All right. Now, if I wanted to see some pound continuation, where would it likely play out best? Well, one of them is probably the pound yen. Of course, you need a steady risk backdrop, but considering how the S&P 500 is leaning, as well as the FTSE 100 and Nikkei 225, that's more likely to be a move to the upside. But there's also actually a break to the downside in euro pound from a fundamental perspective. Makes a lot of sense. Because we're talking about a euro, which is a very risky currency, against the British pound, which if the pound does break to the upside, would be a very divergent monetary policy expectation between these two currencies. All right. So fundamentally speaking, if we do have the right combination of factors, euro pound to the downside makes a lot of sense. All right. But that is very dependent upon how the event risk comes out. This is why I have to really establish and debate with myself whether this is going to be a good trade to hold through that kind of event risk. Most likely it will not be. Now, on the other side of this, the euro. All right, we haven't talked a lot about the monetary policy expectations for the euro, but we have seen that the euro has held pretty persistent. Even after this trend line break here, we haven't had a really significant breakdown. All right, and this has become very frustrating for a number of people who have euro-based trades, whether we're talking about euro dollar or we're talking about euro kiwi. Actually, I prefer the euro kiwi to hold up because I'm actually long off that bottom, that channel floor down there. It's held that support after the New Zealand CPI data, but euro Aussie starting to pull back, as we talked about, and the euro yen, which a lot of people have been watching this head and shoulders pattern and want this to play out, I know, very badly. But interest rate expectations and risk trends are still very important. Euro yen risk trends certainly carry the day as it goes for major fundamental drivers, but the euro itself is also going to be exceptionally exposed to relative monetary policy. So going back to the Euro USD, which the dollar is a great backdrop when we're talking about a hawkish or a very, very early shift towards hawkish from the extreme and dovish end of the monetary policy curve. So when we look at something, when we look at this this monetary policy standing, or at least the market's assumptions of monetary policy standings, we can see that this is at the very cusp, the very edge of the dovish, and it's starting to move on its way towards the middle. All right, that gives us a great backdrop or a great comparison for something like the euro. All right, but what's the euro look like? If we actually look at the monetary policy or the financial conditions for monetary policy officials to consider, as we talked about before, we have some pretty encouraging backdrop from the standards. So when we look at something like the yields for 2-year Italian and Spanish government bonds, extremely low, actually record lows. All right, that's encouraging. That is relatively low risk. I actually flipped this upside down because it's a better one-to-one correlation, but extremely low risk, or at least that's what the market suggests. More likely that is investment flow. All right, realistically speaking, when we look at the shorter-term market rates, they're starting to pick up. The darker green is overnight rates. The lighter green is 3-month rates, and this is a risk. All right, I flipped these upside down because I wanted to insinuate that these yields, when they're higher, it's a reflection that the markets are not confident and they're not going to lend to each other or European borrowers, and there is thereby financial tension, financial pressure. All right, when we put this against the ECB's balance sheet, which exploded into essentially, or through the financial crisis beginning in 2010. See how far back I go here. All right, it exploded through 2011 and when the conditions really started to deteriorate, starting in around April 2010. All right, and they had to, because when you look at the yields that they had to support, these yields were severely troubling for economic conditions. All right. So the stimulus effort ramped up in response, and yields subsequently dropped. Okay. But now we see that with the ECB steadily reducing its balance sheet and doing so through its LTRO payoffs, we're starting to see once again that these yields are picking up. They're increasing, and that's going to cause pressure on a very, very sensitive system. You can just imagine we have a number of Eurozone members who are still in recession. We have a couple of countries that are actually just now coming out from under their bailout programs. Very difficult and very fragile time. And we have a lot of uncertainty still going forward. Right? These are not the time. This is not the time to risk a rise in yields, market-based yields. So perhaps the ECB can act preemptively. There isn't an opportunity in the immediate future for the ECB to act. They'll have to wait till their next rate decision, unless forced, and then things would really be bad already at that point. So something to keep in mind as we continuously talk about relative monetary policy. But as you're seeing, these market conditions are getting a little bit more hairy. So don't just look at the euro as a constant. It certainly is in flux as much as the dollar or the pound or the Aussie. And of course, the yen. All right, we are heading into at the time of this video, the BOJ rate decision. I do not expect a change from monetary policy. They're more likely to act in April. However, since the beginning of the year, the yen hasn't really made any progress. In fact, it set in highs at the end of 2013 and started to retrace again for most of its pairings since then. The Bank of Japan is probably getting a little bit concerned because the market is not giving us the same build-up into the first QE effort that they are now. So there's a little bit of a concern that the effort to devalue the yen, which has in turn been translated into expecting a recovery of trade and thereby growth, is starting to come apart. All right? If these yen crosses start to pull back, there could be a significant backlash throughout the market. The ripple effect would be quite enormous. And if the yen crosses pull back without the implications of risk, that would be quite remarkable. In fact, an unwinding of carry trade through the yen crosses actually could set off risk trends itself. All right, that's how pervasive it is. So a lot's going on, a lot of event risk in the upcoming 24 hours. Right? In fact, this is probably going to be the most active 24 hours of this week. Don't forget the South Korea GDP as well and the Bank of Canada rate decision. But also put in context of the bigger fundamental pictures. This is why we look at these bigger themes and we look at this event risk with the bigger themes in the back of our mind, all right? Because we put it into context. That's how we establish whether we are just getting a small jolt of volatility or the possibility of a new trend development. All right. So we'll update you on these markets once again after this big round of event risk. Be prepared to trade, have strategy, have setups, have scenarios at the ready. Go trading out there, guys. I'll talk to you once again tomorrow.